Options trading basics. Options, which are also referred to as derivatives, can be very risky if used the wrong way. They can also be very rewarding if used correctly, similar to any investment, but it is much more serious with options, as you could potentially lose more money than you can dream of. Options are a very good investment if you are the one buying them, and potentially suicide if you are the one selling them. On the positive side, purchasing the right kind of option can be like having insurance on your stock in case the price declines. Also, a certain option can be purchased on a stock that you don't own, and if the stock price rapidly increases, your option gives you the right to buy the stock at the low price that's agreed to on your option. Let's take a look at some of the option choices out there and which ones to stay away from. If you go against what I'm about to tell you, you may need more than this book to gain wealth, as you may end up in a hole that is too deep to recover from. Call options. A call option can be your best friend, but if used the wrong way, it can quickly become the greatest enemy that you ever had. A call option gives the owner of it the right to purchase, call, a specific stock at a certain price, strike price, without regard to the current value. For example, if I own a call option on Nike stock with a strike price of $30 and the stock rises to $100, the person who sold me the call would be forced to sell me the stock for $30, even though it is now worth $100 per share. Obviously, this would give me a quick $70 per share profit without having much initial risk, since I only paid pennies on the dollar for the option to buy instead of buying the stock outright. On the other hand, the person who sold me the call option would be in a deep world of mess. If he owned enough shares of the stock to satisfy my order, he could just sell me his shares, but if not, then he would have to buy the shares at the current market price of $100 per share and then turn around and sell them to me for only $30 per share. This could obviously put him in a horrible situation, and one that I don't ever want any of my readers to be in, because it could turn out much worse than this. What if the stock price went up to $2,000 per share? The person who sold me the option would have to go out and buy enough shares to satisfy my request at the market price of $2,000 per share, and then sell them to me at $30 and lose a ton of money in the process. If the person owned the shares that he sold me the option on, instead of being forced to buy the shares at market price, he would lose out on what could have been a magnificent profit, since he would have to sell me his shares at only $30 instead of being able to sell them at the current market price of $2,000 per share. Like I said, a call option could be your best friend if used properly, so it is important that you understand how to use one. For example, let's imagine that you've been watching a certain company's stock and you believe it is getting ready for a strong upturn, but you're not sure. Instead of buying 1,000 shares of the company's stock, which would be an expensive investment and a large risk, you could buy 10 call options. Each option contract gives you the option to purchase 100 shares. That would give you the right to buy 1,000 shares at a specified price, so you can still profit from the stock's price gain if it actually does increase, without having to actually own the shares at the time of the increase. Put option. Similar to a call option, if purchased, a put option could be your best friend and used like an insurance policy for a stock that you currently own to protect yourself against a downturn. A put option gives the owner of a stock the right to sell, put, a stock to the seller of the put option at a specified price, no matter what the actual stock price is at the time. For example, let's say I buy 100 shares of Walmart stock at $50 per share. If for some reason the stock price declined to $0, I would be at a loss of $5,000 unless I bought some insurance. If, in this scenario, I purchased a put option with a strike price, right to sell price, of $50 immediately after I bought the stock, and then the stock price declined to $0, I would still be able to sell my shares to the seller of the put option for $50 per share. Therefore, my only loss would be the price that I paid for the put option. In this scenario, the seller of the put option would be the one out of $5,000 minus the small revenue that he received from selling me the put option, which would probably only be around $500. Therefore, the seller of the put option would have a net loss of $4,500, and I would have a loss of only $500. As you can tell, buying a put option for protection is a great idea, while selling a put option to someone else can be a natural disaster waiting to happen. The thought of being forced to buy a stock for $50 that's no longer worth anything should show you the seriousness and potential dangers of selling put options. Like with any investment, options can be good or bad depending on the level of knowledge of the investor. Also, one last note for selling call options is that they are particularly extra risky because there's no limit to how high a stock price can go, which gives the seller of the call an infinite amount of risk.